Good morning, everyone. Yes, I don't mean to be shouting at you too early, but this is Rich Wallace here with an episode of Strictly Business. Our TV show comes on Wednesday, Thursday, and Friday morning at 7 a.m. And you know that because you're here. One of the great things about it is we're part of the Southern California Black Chamber of Commerce from the desert to the sea. So if you're looking to get information, here's a channel to be able to tune in. And we're going to get right at it today. We're going to have someone on to talk about taxes. Yeah, I know, tax season, tax time, what kind of taxes, there's taxes. Are you wholesale, retail? What type of business are you doing? Are you charging the right amount of tax for the county that you're in? Do you know that? Do you even know what's taxable? This is some of the things that we're going to be talking about today here on Strictly Business. I have Mr. Lance Christensen. I think I got it right, but he'll tell me when he gets here. So stay tuned. We're going to take a couple of short breaks and we'll be right back. I see you guys coming in this morning and beginning to join us. So hang in there. And you see the golf picture behind us. So we'll talk about that as soon as we get back. Thank you so much for being a part of Strictly Business this morning.
One of the secrets to exposure for your business lies within supporting Black businesses and entrepreneurs. And that is why the Southern California Black Chamber of Commerce is here, to connect Black businesses from the desert to the sea. Let's join hands to empower and sustain our community. By becoming a member of the Southern California Black Chamber of Commerce, you can grow your business and increase your clientele. With our innovation, we'll generate new businesses and get new customers. And we'll connect new mindsets with businesses from across Southern California to help bridge the wealth gap. Let's connect, build, and grow together. Join us now at blackchamberofcommerce.org.
Good news for the Southern California business community. Now you can add your business to the Southern California Black Chamber of Commerce Business Directory complimentary. We have been working tirelessly to build a list of Black-owned enterprises in Southern California. This is an excellent way for you to be a part of an expansive network and find your ideal customers, business partners, and vendors. So don't waste time. Visit blackchamberofcommerce.org today and add your business today.
And that's actually a complimentary service that the chamber provides. So if you're looking to get listed in a directory, go to our website at blackchamberofcommerce.org, sign in. You don't have to be a member. It doesn't cost any fee, and log your business in the directory. And I guarantee you that directory is shopped on a regular basis for people that are looking for minority, Black-owned businesses, Hispanic businesses to be able to fulfill their contracts or whatever it is that they're trying to do, or maybe they're just looking for you and they want to do business with you. Once again, I am Rich Wallace. You have joined an episode of Strictly Business. I see you guys are coming in. Thank you so much for joining us this morning. We're going to have some information about taxes and business revenue, what to keep, what you don't keep. I know a lot of times people say, well, I make this amount of money. Well, how much can you keep? That's where we're at today. We've been talking about doing your budgets and packaging your certain businesses and being an entrepreneur, being on time, time management, and some other things that we've been discussing in the past. And today we're going to talk about the taxes that you charge coming over the counter. And I have our guest. I'm going to log him in right now. Good morning, sir. How are you?
I'm doing good, Rich. How are you?
I am doing well. Can you let folks know who you are and just kind of give us an overview of our taxable situations that we have today in retail business as well as wholesale? I'm not sure if there's a tax there or not. You will let us know.
Yeah. So my name's Lance Christensen, and I'm the information officer out of the Riverside District Office. And I'm with the CDTFA, which stands for California Department of Tax and Fee Administration, better known as the sales tax people. So even though we're coming up on April 15th, I'm not income tax, so don't hold that against me. I'm sales tax only. So like Rich mentioned, the tax that you pay when you go to a retailer and you buy something. And that's what the CDTFA does. So what I do is things like this. I do webinars and classes and workshops and try to teach business owners the ins and outs of when it comes to collecting sales tax, like Rich said, how much you're supposed to collect, what's the tax rate, when you have to change that tax rate. Also, what is taxable and what is not taxable. There's still things such as food when you go to the grocery store. That isn't taxable, but you go to a restaurant and buy food and it is taxable. So as you can see, it can get a little bit complicated, but I do like to always mention to people that luckily I have to know about tax, sales tax, no matter what the type of business is, but you don't. You only have to know about the sales tax for your type of business. So all the ins and outs of auto repair don't matter to you if you're a restaurant. So the key for you would be to just get down the tax that applies to your type of business, and you'll be in pretty good shape, I think.
Lance, what is the difference between the Board of Equalization and you, or are you the same?
We're not the same. Board of Equalization back about, let's see, what are we at now? About 4 years ago, I think it was were the people that were in charge of sales tax. And then the legislators sort of split us up and created the CDTFA, California Department of Tax and Fee Administration, and we took over the sales tax aspect and taxes and fees in general. Now, Board of Equalization just deals with property tax and works with county assessors and that sort of thing.
So I would get my resale number from you guys? Is that?
Yes. So anything to do with sales tax, you get your seller's permit from us, from the CDTFA. Any other permits, like depending on if you had a business that sold tires, you would get a tire permit, or you had hazardous waste, you would get all those through us now. Yeah.
Okay. Now, or I'm in the print business somewhat. So is printing taxable, or is printing on shirts taxable? If I go down and I buy 20 shirts at $5 a pop, and I pay taxes on them, and I come back, I print some stuff on them, and I resell those shirts, do I charge taxes?
Yeah, the easiest way to think about that is we always like to say tangible personal property. That's what's taxable in California. And that's a fancy state way of saying things that you can touch, weigh, measure, or hold. If you can touch, weigh, measure, or hold, then they're tangible. And pretty much, with some exceptions, when you sell those kind of things, you charge tax on them. And it doesn't matter in most cases whether you paid tax up front or whether you bought them with a resale certificate. And that's generally what we suggest if you're a retailer. You get a seller's permit from us. We issue you that. And that gives you the option to go out and go to your vendor and create a resale certificate, which is like a little contract between you, the retailer, and your vendor, your wholesaler. And they give you the items that you're going to sell in your store tax-free, with the thinking that when you sell them in your store, you'll collect tax on your end to the final customer. And that's basically the way it works with seller's permits and then resale certificates, and then doing business as a retailer.
So now, do I need a resale license if I'm selling, and are there such things as non-taxable items?
Sure there is. And the good example again is food, for instance. Like I said, when you go to the grocery store, most of the food that's unprepared and such, when you'd buy that, that wouldn't be taxable. There are certain instances when you may not need a seller's permit. In most cases, it's best to get one right up front, at least. Really, the process, which you can get a seller's permit completely online now. You don't have to go into our locations, although you can. But you can get the whole thing online, and the system, as it's asking you questions and you're giving the answers back, will figure out whether you need a seller's permit or not.
Okay. And the website for that is that
is cdtfa.ca.gov.
Okay.
www.cdtfa.ca.gov. And luckily, we made that right before COVID hit. We sort of upgraded that and really made it so that even though people couldn't come into our offices during COVID, they could still pretty much do everything they needed to do on our website.
And once they fill all of that out, and if there's any, is there a fee for a seller's permit now? Or?
There is not. There is not. The only time that there would be a fee is if you previously had one and then you got behind in your taxes to the point that it got pulled and now you want another one. But if you're coming in fresh, or you had a business for a while, closed it out, now you want to open up another one, or you're changing the type of thing, no, there's no fee at all. And again, you could do the whole thing on our website and have it the same day.
Okay. Now, as a lot of entrepreneurs, we do 2 or 3 different things.
Sure.
Do I need a seller's permit for each business, or does one cover my print shop and my taco shop?
Generally, if it's different types of, you can have different locations of selling the same thing, and then one seller's permit is fine, because you just add those what we call sub locations onto your original seller's permit. So it shows this address is my business, this address is also my business, but it's all on the same one. But that's if you're selling pretty much the same sort of thing. If you have separate businesses like you're describing, Rich, then generally we would issue one for each of those different types of businesses. Again, they would still be free, but they're different accounts just because you're doing something different in those. But yeah.
Okay. All right. Now, is the taxable situation, I heard from one of our accounting people that there's a different tax in LA County as opposed to Riverside County, as opposed to San Bernardino County, or is it just one taxable situation for the same items? How does that work?
It's not too different throughout the state as far as what's going to be taxable and what isn't taxable. The difference is going to be the tax rate. So if you think of it this way, so the state of California, the state rate is 7.25. And there are still cities in California that's it. That's, if you're doing business in their city, you would charge and pay that 7.25. But most cities and counties have added a district tax onto that. Maybe you see at election time, you might see something on your ballot that says this city or this county wants to add an extra 0.5-cent sales tax or 1 cent sales tax, et cetera. Well, that's taken place over the years. In fact, a whole bunch just clicked in April 1st. So a lot of places went up. Unfortunately, they don't go down too often. Sometimes they do, but not too often. So that's why throughout the state, your tax rate might be 7.25, 8.75, 10. There's different rates all over, and it just depends on how many district taxes have been added on there. And again, that could be a city adding it or a county. Sometimes there's even some like transportation districts or something that might add it on, but generally it's a city or a county. And you add all that together, and if you're doing business in that city, you charge that full rate all added together.
Now, when I get my resale number from you, will you let me know based upon my address what taxes I should be charging? So, because I'm not a tax guy, I don't know if I'm LA County charge or should I be Inland Empire charge. And I guess the backup question is, if I don't charge enough, am I penalized, or do I have to make up the difference?
You will have to make up the difference. Basically, I'm not sure that when we issue the seller's permit, that telling you what the tax rate, where that is necessarily part of it, but it's pretty easy. Again, if you go to our website that we mentioned, cdtfa.ca.gov, there's a great big icon there that says find tax rate. And you can go into there, and we have listed alphabetically every single city in California, even the unincorporated ones.
Okay.
And when you click on that, it'll say what the tax rate is. If that isn't precise enough, also going through Find My Tax Rate on our website, you can actually put in an address, a street address, and it'll bring up, here's what the tax rate is at that address. So say you were going to go and do selling in another city that you don't normally, maybe you're going to a festival or something. You could put that in ahead of time, and then you'd know exactly how much tax you should be charging on those sales there. Or if you're shipping something to someone and you have nexus in that city and you have to charge their tax rate, then same thing. You could put in that address and it'd tell you what the tax rate is that you're supposed to ask for. Yeah.
Okay. Now, it used to be that I'm getting an echo. Maybe it's me. It used to be that you would get a chart from, I don't know if it came from the Board of Equalization or where it came from. And on that chart, if it said between $10.99 and $12.99, you would charge whatever the rate came out to. It would tell you the dollar amount that you would charge. You guys provide that or anything like that now?
I don't think that's probably us. I've never seen that within our paperwork. I'm sure you could get various business support groups or business supply stores that would have that, because since the tax rate changes from city to city, of course, it'd be slightly different. I know exactly what you're talking about, where it shows it, so you could just look up easily on a chart. I just sold something for $10.87. What's the tax on this?
Yeah, because my sales rep wouldn't know that, or my retail clerk, my hourly person that just popped in for 4 or 6 hours a day. How would they know which tax? And I guess if you build it into your register, maybe.
Yeah, that's generally your point of purchase system, whatever it is. You can certainly program that in. Generally, if you're doing a sale out of your store or your retail location, it's always going to be the same tax rate anyway. Okay. Sometimes too, you can set up your point of purchase system so that if you're selling some taxable things and non-taxables, like we keep talking about food, if you're at a grocery store, you're not taxing the food, but if you're also selling cigarettes, or you're also selling lighters, or you're also selling like prepared hot food, then you might have some things that are taxable and not. And then you can set that up in your point of purchase. So whenever one of those things get sold, it says what the tax would be or if it's non-taxable.
Okay. All right. We're going to take a real short break, and then we're going to come back and we're going to talk about taxable items on the nonprofit side, where raffles and things like that. So guys, stay tuned. We'll be right back.
Are you ready to change your life? Let us help you. At Youth Build Charter School, you can get a high school diploma and kickstart your dream career in no time. We offer high school diploma programs in construction, CNA, military, college, and entrepreneurship. If you are between the age of 16 and 24 and you want to manage your studies with a job, recover your credits, or graduate early, we can help you achieve your dream. Call us at 1-888-395-4408 or visit youthbuildinlandempire.org.
I've had this problem.
Big problem.
I really needed
A good business consultant.
And I kept searching and searching.
There are so many choices.
It's really hard to find one that has all the things on my list. But I finally did it.
Yes. Thank you.
If you are looking for one as well, look no further.
Here's a really good one.
Just use mine. Use mine.
I'm very satisfied.
Definitely recommend. Problem gone. Thank you.
Hey, and we're back. Okay. Did a couple of quick commercials. We have a charter school, Youth Build Inland Empire. It's our educational program through the chamber. So if you know someone that's 16 to 30 that needs to get a high school diploma or a trade, they want to pick up a trade, give us a call over at Youth Build Inland Empire. We have a video production and some other things going on over there. So check us out. We're here talking about cross the counter taxes, I guess is what we call them. And there's so many questions about raffles or now opportunity drawings. What's taxable in the basket, or is the basket not taxable? As a nonprofit, we still pay taxes across the counter when we buy things, because most of the time we're not actually selling them. But we give away T-shirts and hats and these kinds of things. Are those things giveaways? Are they taxable? Who pays the tax on them? Or can we just charge it to the people they win?
Yeah. So when it comes to nonprofits, it's kind of interesting, Rich, because it really comes down to what sort of nonprofit you are, and then the rules kind of change. So for the most part, the quick answer is even though you're a nonprofit, and this happens a lot of times, a nonprofit will get that 501c3 designation and they think, well, all my tax worries are over. But unfortunately, that doesn't apply to sales tax. So even though you are getting that break on the building where you hold where your nonprofit is located and such, and you might have some income tax, some special features with that, doesn't apply to sales tax generally. So when you are selling things during fundraisers, you're having rummage sales, you have a Christmas tree lot, you have a silent auction, generally all those things are going to be taxable. Um, it again depends on what sort of a nonprofit you are. There's certain nonprofits, and just ones that come to mind, ones that are like representing a school sports program, religious church organizations. They might have a particular exemption on food, for instance. So they can hold as many pancake breakfasts and spaghetti dinners as they want. And during those, much of the food wouldn't be taxable. But if they turn around and also have a rummage sale, those items are going to be taxable. So the best thing that you can do is, again, if you go to our website, cdtfa.ca.gov, you'll find publications, or maybe the easiest way is just go to the search engine right on the front page, type in nonprofit, and there'll be a publication that comes up that talks about nonprofit organizations. And when you go through that, you can find the one that describes your nonprofit the best, and it'll say, what are the rules for you? There's very, very few that get a complete free tax ride. Generally, those are ones they have to get approved. They're usually what we call relieving poverty and distress. So if you think of like a homeless shelter, but most others have specific rules and what they can do tax-free and what things they need to charge tax on. Also, you brought up the question about raffles, and that's always one that's very popular, of course. And really, we, the CDTFA, do not have a whole lot of rules about raffles. The main thing that I always tell people is, as far as we're concerned and sales tax is concerned, is you want to make sure that everybody doesn't win. So if you have a raffle, you want to make sure there's people that lose, because if you think of it this way, if everybody wins something, then it's too close to being like a sale. You're paying something for the ticket and you're always getting something in return. That's a sale and that's going to be taxable. But if only one person wins or only a couple of people win and the rest lose, then there's no tax sales tax problem there. The one thing I will point out, though, is you might want to check out the Department of Justice website, because they have a lot of rules that apply to doing raffles. You're supposed to tell them ahead of the time that you're going to do one. You're supposed to explain it out. You're supposed to get approval. And then when it's all done, you're supposed to tell them how it went. So that's not a CDTFA thing. But if you look at the State Department of Justice, you'll see they have a whole section on running raffles and what the story is. There's also some rules about the percentage of people that can win, or the percent, I should say, not that, the percentage of how much money you take in compared to the prizes that you're giving out and such. So again, those aren't CDTFA things, but I suggest that you go look on the Department of Justice website.
Well, I'll definitely check that out, because we have a TV that's been donated. We have a celebrity golf tournament that comes up. We charge for the golf tournament, barely making any money off of it because golf is so expensive on tournaments today. So to keep the price down, we go after sponsors for the golf tournament and this kinds of thing. Somebody donated a TV. So the first thing comes to my mind, I'm like, okay, if who's going to pay the taxes on this TV? I don't know if they got the television donated, or if they bought it wholesale, or if somebody gave it to the company and they gave it to us. So who pays the taxes on the TV? The winner,
Yeah.
or does no one pay?
If it's being given away as a prize, generally that's going to be a situation where it probably won't be taxable. That's one actually good thing, and one sort of note for nonprofits. So generally, a business, if they pull things out of their resale inventory and give them away, maybe they sell T-shirts. You brought up T-shirts earlier, or let's go and say it's an appliance store and they sell TVs. So they have a whole stock of televisions. They got those at wholesale. Generally, when you give away things out of your resale inventory, so in that case, it would be their TVs, you're going to owe what's called use tax. So the business itself will owe tax on what their cost of that TV is, because remember, they got it at wholesale because they said, oh, I'm going to resell it and then I'll collect the tax. Well, if you're giving it away, you're not reselling it, you're not collecting tax. So you're the final user and you owe what we call use tax on that, which is the same rate as your sales tax rate. But the one thing that those retailers can do is if they donate it to most, not all, but most charities, then they don't generate use tax. And that's something good for charities to know, because a lot of times maybe you're doing a silent auction or some sort of an auction situation, and you're going to your retailers looking for donations to use for that. You can tell them you don't owe any use tax when you give it to us, whereas if you gave it to a homeless person, you would. So it's kind of an interesting situation where you can make those donations as a business to charitable organizations.
Now, does your department distinguish between our Chamber of Commerce is a 501c6? We have an educational program that's a 501c3. So I know they're different on some level of what the donator could actually write off. The 501c3 allows them to write off more. The 501c6, I believe, allows them to write off less or none, depending on what it is. Is that a difference in the retail taxes that you guys have between the two nonprofits?
Yeah. In most cases, and this is kind of just a general statement, in most cases, I'd say it won't be that much difference in sales tax. First of all, one of the things generally when I start a webinar, just to get people on the same platform with me, is that if you start asking those questions like you did, Rich, where it's like, can I write off this or can I write off that? Those are generally income tax questions. You can write off things for your income tax. When it comes to sales tax, you're really not writing anything off. There'll be some things that are not taxable, and there'll be some things that are taxable. But as far as business expenses and such, those are going to be more income tax questions. And as far as whether the income tax might be different for those different C designations that you mentioned, they could be then, but really that's sort of out of my field as a sales tax guy.
Now, from your perspective, how do you know what I charge tax on, if I charge the right amount, or if I even charge tax? Is there the report that the small business turns into CDTFA is based upon my inventory? Do you know, how do you know I still have the TV in stock, or if I didn't sell it? What is a reporting system, I guess, that the small business, and I'm sure there's some type of form they fill out and turn in.
Yeah. So when you get a seller's permit, that means generally you make sales of things, tangible personal property. And when you have a seller's permit, then immediately you have a filing that you do. And it might be once a year. Might be once a fiscal year. It might be once a quarter. It might be once a month. And it all depends on when you got that seller's permit, what you told us, the amount of sales you thought you would probably end up having. That determines how often you file a return. So it's when you file your sales and use tax return that you're reporting, here's how many sales I made, here's purchases that I made from out of state that I owe tax on. Basically, again, when it comes to sales tax, if you've got still things in stock, but they're still available to be sold, there's no taxability yet. You can keep them for 30 years. And as long as someone can still buy them, even though you bought them at wholesale, there's no tax as long as someone can still buy it. It's when you pull it off of that shelf and keep it for yourself, or give up that you're not going to sell it, give it away to a family member, or you sell it. And that's what you're doing on a sales and use tax return. You're telling us, here's the amount of sales I made. Some of those sales might be tax-free, and some of them might be taxable. And that's what the form, when you're filling that out, determines. So by the time, we'll have all the questions about, did you have any sales to customers who were out of state? Those wouldn't be taxable, for instance. So you'd be pulling those out of what your total sales were. And so by the time you get through all those exemptions and such, then you'll have a final amount that's taxable. And at that time, you also pay your sales tax.
Okay, now you bring about an interesting question. Online sales, are they still taxed the same? The shirt that I sold online as opposed to the shirt that I sold at the festival?
Yeah, the main difference there is going to be, depending on the situation, it might change the tax rate. So first of all, if you're selling online, it's taxable just like if you were selling out of your brick and mortar store or at a festival and such. The difference sometimes happens is whether or not you have to charge the tax rate of where your customer is located, or you can charge the state rate of 7.25, or you have to charge your own rate. And it all comes down to, with that customer, with that sale, have you done something to create a nexus in their location? So there was a new law that came about 3 years ago. You might have heard of the Wayfair decision, and part of that determined that if you do $500,000 worth of sales in a year in California during the past 12 months, then even if you're shipping your items off to people in different parts of the state, you have to charge the tax rate of the customer where you ship it. Now, if you haven't done that, if you haven't done $500,000 worth of business, then in most cases, you can charge either the rate if it was a customer in the same city as you, even though they bought it online, but you're shipping it to them, you could charge them your tax rate. If it's outside of your county, then you could probably charge them the state rate of 7.25 because they didn't come into your district to buy it and you didn't bring it into their district to hand it over. We always like to say, like, the tax rate's determined by where the sale takes place. And the sale takes place when the merchandise changes hands. So if you're delivering it to somebody, when's the merchandise changing hands? At that location where you're delivering it to, and that's the tax rate you have to charge. Whereas if it's just in your store, then that's where the tax rate is. So that's sort of what determines how much tax you have to charge.
Now, there's so many people now doing street vending business, out of the garage business, home businesses today are higher than anything. Everybody has a side hustle, and the IRS has come up with a way to track your side hustle through PayPal or Cash App or Venmo, however you were taking your money. So now those small vendors are like, okay, now they're coming after my little side hustle. So on the side hustle, and I got a street vending, I'm selling tacos in the middle of the night. Are those things taxable to those, or does everyone that sells anything have to have a resale license?
Yeah, so first of all, yeah, even those taco trucks and such, they are all supposed to have a seller's permit. If you're selling something that's normally taxable, doesn't matter where you're selling it out of, whether it's a big brick and mortar restaurant, for instance, or it's a truck, or it's a cart, or it's your home. That doesn't change the tax, whether it's taxable or not. The difference is going to be, is the thing taxable in the first place? So still in California, for instance, service if it's just a service type business, and I always like to say like a landscaper or a dog groomer, people that just don't, when you're done and you pay them, they haven't given you an item that's tangible, then they don't have to have a seller's permit and they don't charge tax. It's just in California, when you sell something that's an item that's tangible, then that's where the taxability is generally going to come in.
Okay. Okay. Very interesting. So if it's a non-tangible item, I'm trying to think of what that would be. That if, as they say, if you can't touch it, smell it, then it's not taxable. So,
I have a
and
good example for that, actually. That's another interesting aspect. So, if you think about things that are delivered digitally these days, like maybe photographs, maybe an e-book, sometimes there's instructional videos and such that you just get over your computer offline or such. Perfect example is like a photographer, a professional photographer. If a professional photographer does a shoot for a couple that got married, and then the photos are finally done, he's got them all finished and developed. And if that couple then gets those photos online only, so they're getting them digitally, maybe they are getting emailed to them, maybe they're going to that photographer's website and downloading them, maybe put them up on a cloud and they're going to download those photos. If you think about things that are digital, they're not tangible. You can't touch them. You can't weigh them, measure them, hold them. They're just in a digital form. So as of right now in California, if you were that photographer and you sold photos to someone, none of that would be taxable because there's nothing that's tangible involved. Whereas if you turn around and give that same couple a photo album, well, now that is tangible and it makes all your charges that led up to that also taxable. So that's something, that's something to keep in mind. If it's still just digitally delivered, and that means, like I said, through email or they're downloading it themselves, etc., not taxable. You give them a flash drive, well, now you got a flash drive that's tangible and you got to charge tax again. But if it's just purely digitally delivered, not taxable. Think of music like that too.
Okay, so download your albums and all of that kind of stuff if you need to save a couple of dollars. Getting back to the nonprofits, we have a lot of nonprofits that raise funds for whatever reason. Our celebrity golf tournament that's coming up, we get a gift basket from XYZ or, very small company, and they give us a gift basket. It's got soap in it and it's got taxable items in the basket. They made the basket, are they paying tax on those items? Or if they paid tax on the items, stuck them in the bag, I would never know that they actually pay taxes on it. So is there a double tax that you guys are getting that people don't know about? Because I don't know you pay taxes on it. You gave it to me. Now I got to charge taxes on it. So is there a checkoff system so that the CDFA doesn't get too much money?
Yeah, we certainly don't want things double taxed. And I think when we first went on this morning, you were mentioning a situation like if you go and have T-shirts printed up and you pay the tax up front, then when you are selling them, do you have to charge tax again? And I'll address that first because it's a good example. Yes, you would. You just think of it as a new sale. Every time someone's making a profit or you're selling something, it's a new sale and you do charge tax. Now, in that example, though, that you gave, when you go to file your return with us, your sales and use tax return, we have something called cost of tax paid purchase resold. And what that means is you could, if you sell those T-shirts and you charge the tax on your end when you sell them to the final person, When you file your return with us, you could take a cost of tax paid purchase resold credit and the tax you paid to your vendor that when you bought them up front, you could get that taken off the tax that you owe. And a lot of people don't realize that they can do that. Think of it again as we suggest, and what you really should do is use resale certificates whenever you can. Then you're getting things tax free. But if sometimes there's situations where maybe you can't do that, or the person you're buying your stuff from doesn't want to play ball with you and you pay the tax up front, or you're in a time situation, you just have to run to Walmart and buy some stuff. They're not going to play ball with you probably, and you're going to pay the tax up front. But just remember, when you go to file your return in that sort of a situation, as long as you charge tax when you sell it, which you are required to do, you can get the tax back that you paid Walmart or that vendor on your filing. So in that way, things don't get double taxed.
Okay, because the tax that I paid the vendor will be lower than the actual tax that I'm taking in because I'm selling the shirt at a higher price.
Sure.
I bought the shirt at $5. Now I'm selling it at 10. So I'm charging them the tax on the $10.
Exactly.
Okay.
Exactly.
Yeah.
And then your basket example, I didn't want to get too far away from that, but there is a lot of ins and outs when it comes to selling baskets. And you remind me to remind folks that, one, there's a publication for nonprofits on our website, again, that you can find. Just look up publications or type in nonprofit. You can find that publication. Also, we do a webinar or workshop or class, however we want to do it, or however our host wants to do it, for nonprofit organizations, which I strongly suggest all nonprofits take. It's very eye-opening about what it is that's taxable and what's not. We talk about the different types of nonprofits. All of our webinars are free, or workshops, they're always free. And you can learn what's taxable and what isn't. Because when it comes to a basket is different as far as its taxability on, one, is there things that are in it that would normally be taxable? So if the thing is filled up with food, like jams and jellies, for instance, it's not going to be taxable because those aren't taxable items. But if it has other things in there like coffee mugs or wine, those things are taxable. Then it's going to come down to sort of what you were explaining, Rich, which was you don't know if they paid the tax up front. You may not know how much each individual item in that basket cost, because that's what you sort of have to know to charge tax on it. Basically, in a nutshell, and I'm oversimplifying it, if you get a basket and you don't know how much anything in that basket is, if the taxables are over 10%, then you're probably going to just charge tax on the whole price of the basket. If you do know how much everything cost in that basket, because you put it together yourself, then you can just separate out, and the taxables, like the wine and the mugs, create more than 10% of the whole value of that basket. Now you're going to just charge tax on those individual items. They're worth, because you have the receipts, you know how much they cost. That's how much the tax is going to be. So you can see it differs about how you got the basket and what's in the basket.
Okay. And we have a couple of event planners on, and they're asking, do you charge tax on renting their facilities? And if they're using tables, they rent the facilities, the tables are different, the chairs are different. Are those taxable items, even though I don't get to take them home?
Yeah, so when it comes to rental and lease companies, particularly ones that do party planning and such like that, and that you get tables and chairs. I did that recently for a little gathering that I put together. For those leasing companies and those rental companies, it's kind of interesting. It depends on how they got those tables and chairs, how they got the bounce house that they're renting or leasing, as to whether they charge tax or not. Again, it goes back to when they bought it, did they use a resale certificate? So they got those tables and chairs wholesale? If they did, then when they lease them or rent them out to the different customers, they have to charge tax every single time.
Whoa.
If you instead bought those tables and chairs, now I'm the vendor again, the caterer or whatever you want to call them. I'm the vendor and I bought those tables and chairs and I paid the tax up front right at the time I bought them. Then every time you rent them or lease them, you don't have to charge any tax. But once you've done it one way, you can't change that around. You're in. So that'll determine whether you're taxable. As far as the event, the person holding the event, so that'll decide whether or not they're paying the tax for those tables and chairs. After that, it's going to come down to, is the hall taxable? Generally, it depends on if food is involved. That's another one. If you are in the food business, you need to take our food industry webinar because it explains all that out. But generally, if food is involved in that part of the hall, then the rental of it is taxable. If it's not, then it's not. So if you think of, we like to use an example of, like, it's very popular these days to get married at wineries. So if they're doing the reception where there's food involved, then the rental of that room is going to be taxable. But if they're also providing like just a place where the bride and groom get ready for the ceremony, or maybe even where they're the chapel where they're getting married, and that's a separate charge, that wouldn't be taxable because there's no exchange of tangible personal property taking place in that room. So it's just a service. But if there's food involved, you got to charge tax on the room.
Okay, now, if the food involved came from a food vendor separate from the location, which sometimes they don't have kitchens, you bring in your own caterer, so to speak. Your caterer that brought the hot food in charges taxes. Is that right? Okay. But so you're not paying taxes on the location, or you are paying taxes on the location? So because I'm being taxed on the food that the food vendor's bringing in, I got the location. Am I being taxed there too?
Yeah, generally, it would come down to that. That will probably change the taxability of that room. If there's something taking place, and you brought up catering and such, and catering is generally going to be taxable. If you're hiring a caterer, for instance, or whoever you bring in, you're catering if you're also serving the food. If you're just dropping off the food, then the food may or may not be taxable. If it's hot food, the food's going to be taxable. If it's a giant 6-foot cold sub sandwich, that's not taxable because it's cold food. But if it's being served up, then the caterer has to charge tax on everything involved with that event, pretty much. But as far as the room, getting back to your original question, if there's food taking place in there, then the room's going to end up being taxable. If there isn't, then it's not.
Okay.
In a nutshell.
My caterers are like, really? Yes, really. Okay. And this is one of the things that you need to be able to do, is to go to CDTFA's website so you can get the correct information, so that the tax situation does not cost you an extent later. Now, are you like the IRS? Do you audit people?
Absolutely audit people. Yeah. And the best thing you can do there, the old problem always is that ignorance of the law doesn't help you. So you got to find out. And that's why, like I suggest, our webinars, our workshops, and just our publications, find out what's taxable and what isn't when it comes to your type of business. We have all kinds of publications that are just for the restaurant business, just for auto repair, just for nonprofits. Find out what's taxable and what isn't. Also keep aware of that use tax when you're pulling stuff out of your resale inventory and keeping it, giving it away, giving it to a family member, that generates use tax. When you buy things for your business, that you're not going to resell, like shelving, furniture, etc. If you buy them from out of state, and that out of state company, and a lot of people are buying things online, check to see if that out of state company charges you tax. If they don't, then you're going to owe use tax on those items. So those are things you got to keep track of, because yeah, we audit people, and probably the next question is how do we determine what we audit? Most of the time it's random. If your tax returns start looking questionable, then you're more likely to get audited. So
If you don't owe any money anytime, then you're going to be audited.
well, there's still a very small percentage, honestly. I think it's like 3% or something like that, but you never know. Certain types of businesses might get audited more often than other types of businesses. But the best thing to do is keep really good records, and then make sure you understand what's taxable and not taxable in your type of business.
Okay. Now, do you suggest, I own restaurants in Texas for a while, and we charge tax there, I think. I can't remember. But there were some items. We did a separate account for the taxes. The register told us how much tax was charged for that day. And we took that 50 or whatever dollars that was and put it in a separate account to keep control of it, because we had 6 or 7 restaurants, and it was really, we'd gotten into a situation before that we got confused on your money and my money and that kind of thing. At the end of the day, it's like, okay, the light bill's due. We made enough to pay the light bill, so pay the light bill, but all of that money was not ours. So after a month or so of figuring out that, hey, we got to pay the tax bill. We reinvested the tax money, which I probably shouldn't have done, but I don't own them anymore. So I guess the time of
the statute of limitations.
Statute of limitation is over. So, but what do you suggest to small businesses in tracking that? Because I'm on a day-to-day operation. I'm moving at 100 miles an hour, and the register says this and says that, but at the end of the day, I got enough to pay these 2 people at work and to pay the light bill. And I do understand that all of that money wasn't mine, but what is a suggestion or an easier way to be able to account for that, so that at the end of the quarter, you don't look at a bill that's $8,000-9,000?
Yeah, and actually your suggestion there, Rich, is excellent. And that's a very good suggestion, because here's the problem. You're earning money, and say a restaurant, and you are taking in money and you're reinvesting that in your restaurant, or maybe you're taking that money and you go and buy a boat with it. But keep in mind, the sales tax, you just get to hold that for a while. So we always say sales tax is different than income tax. First of all, it never comes out of your income. It's separate. And third is it's paid by your customer. So it's not coming out of your wallet either. You're collecting it from your customer. But then you're the middleman, and you just hold it until it's time for you to file your return and pay your sales tax. And it's an excellent idea to set up a separate bank account and just funnel it in there as you go. And just know, I can't really touch that. That will need to be there when it comes time to pay the sales tax. And if you think about it, even though it's not your money, if you only file once a year, once a quarter, you can actually get interest on that money that's sitting in that bank account, even though it's not yours. And then when it's time to pay, it's going to be there. You've gained a little interest off of it, and you'll have it there to pay. Because again, the problem comes when people roll all of it together, and then maybe they lose track of it, and then they're buying things for their business or themselves, and then it comes time to file, and you don't have it anymore. So that's a really excellent suggestion, Rich, is to just funnel it straight into an account as you go.
Now, is there a payment plan that small businesses that didn't keep track, and I look up now at the end of the quarter, it's time to file, and I've been doing all my paperwork right, but I'm just barely staying open. The pandemic hit, for whatever excuse I have now, and I guess at your department does excuses work. So what does a small business guy that trapped himself, can he get out? Is there is there grace and mercy in the CDTFA?
Certainly, first of all, if there's a reason that is, like, for instance, right now, there's a lot of people's businesses that are affected because of the winter storms and snow and floods and such. And they had a special program where if you can't pay your tax, or you were affected, your business was affected because you were snowed in, or you had a flood in your area and such, they get an extra 3 months to file and pay their taxes. Maybe they need that money to get by on for the next 3 months and such. So they get a 3-month grace period. But if you're not in that situation, and say you did, you didn't keep track of it, you went to file, you didn't have it to pay. First of all, file your return anyway. Keep in mind that filing a return and paying are two separate things. So just by filing your return, you're saving yourself a late fee for filing late. So get that filed, and then you have a full month. So if you are filing once a year, for instance, you would collect sales tax from January through December, and then you have the following all of January to make that payment and to file your return. If that is still not enough and you don't have enough, we do have payment plans that you can get on, and you'll have to request that, but you can request that through your account where you are making individual payments. It's going to depend on the situation and how much you owe and such, but they are available, yeah.
So don't get yourself trapped is the key. I got one other question that somebody's asking here, and it's about bartenders and selling alcohol or reselling alcohol. Someone hires you as a bartender, you own your own booze, or you go out, you buy it, you sell it to their people. Is any of that taxable? Does that fall under the alcohol and people?
It's actually still taxable. It wouldn't matter. There's a lot of you also have to be careful. And again, I'm speaking outside of the CDTFA, that alcohol is very tracked, and stores that sell it and bars that sell it have to really track where they're buying that from and where they're selling it to and collecting tax on it and such. So got to be careful with things like that. You honestly, you can't just run to your local Costco and buy alcohol and use it in your bar. You have to get it through distributors and such. So, but the short answer to your question is, yeah, even if you're an individual bartender, you're going to be charging tax on that alcohol, because alcohol is always taxable, just like carbonated beverages are always taxable.
So really? I'm having an event. I pour you a glass of soda. I charge you 50 cents for that glass of soda. That's taxable?
Absolutely. Yeah. Carbonated beverages, because it's one of the foods that is taxable originally. So you could use a resale certificate to get that. Most food you wouldn't have to, because it wouldn't be taxable. But alcoholic beverages and carbonated beverages are taxable all the time.
Okay. By the glass.
However you're selling it. However you're selling it. If you're selling it by the bottle, by the cup, by the sip, whatever you charge, that's the thing that's kind of easy about sales tax compared to other things, is whatever the price you pay, that's what the tax is based on. Even if you have a buy one, get one free, okay, well, how much was the one then? Because that's how much you charge. That's what the taxable amount is.
And the one free, though, there's no, do I pay a tax on that one? Because I gave it away.
Basically, what it would be looked at is if you charged half price, and that's what the taxable amount would be. Yeah.
Okay. All right. Okay. Wow. This time has gone by quick. So if we've got any last words there, Mr. Lawrence, I'd appreciate it. And of course, I'm going to get with you. I'm going to set up some seminars to get some small business people in, because they're filling up the chat. I can't answer these questions fast enough. So, but we'll give you the last minute or so to just kind of let them know how to get to the website. And the use tax is something that's really important, because I think a lot of people might be using stuff, Yeah, that
A lot of people
because if
don't
I buy
realize.
20 T-shirts and I keep 2 of them for myself, that's a use tax. That's different
Exactly.
from the, yeah, okay.
Yep. Yep. Yeah. You can, again, our website, you can do just about everything, cdtfa.ca.gov. Also, we have a customer service center, which is a phone number 800-400-7115. I say that again, 800-400-7115. It's the customer service center. It's open Monday through Friday, 7:30 in the morning till 5 in the evening. And you can call that number to ask any kind of tax question. You can ask questions about your own account. Whatever you need to ask about sales tax, that number is available for you. And I'm told, compared to most agencies, there is very little wait time. So, and they're very helpful there. So that's another great way to get information.
Okay, guys, go online and get your sales permit. We got to go. Thank you, sir. We will talk again. Have
Thank
a
you,
good
Rich.
day.